Within the investment community, there is often a debate between growth investing and value investing. Which one is better? But what if I told you that synergizing these two approaches is often the way to lead to multi-bagger returns? The debate often goes, the best companies are expensive, you need to pay for this growth, they're the ones that are going to grow, they're the ones that are going to have larger markets in the future, and thus larger market caps and become the most valuable companies in the world, the Apples and the Amazons of the world. And then you've got the value investors that are saying, you're paying $1 billion for a penthouse in New York. It's worth a lot of money. The best penthouses might be worth 50 million, but they ain't worth $1 billion. You are paying too much. And thus they buy stocks that look cheap. But combining these two approaches leads to often very outsized returns, as I mentioned. In the book 100 Baggers by Chris Mayer, he has this analogy of the twin engines, which is a very powerful strategy that I wanted to share with you today, which actually, when combining these two together, can lead to outsized returns. Let's say you've got a company growing 25% compounded annual growth rate. That can be on the top line, the bottom line. For this video, probably the top line is more appropriate, and I'll explain that later for growth companies. If you have 5-year, 25% a year revenue growth, you've actually got a 3x in revenue over 5 years. Pretty impressive, right? That shows you how compounding something again and again and again can really add up. But what if this company also had an increase in valuation multiple? What if at the start of those 3 years, the company was trading at a PE of 20? The jury was out. 3 years down the road, the market recognizes the company's true value. They understand that they're in an industry that's growing. They're going to be the leader, and thus they apply a PE multiple of 60, particularly if those growth rates sustain themselves or even better, reaccelerate. What would be the return on the shares then? Well, think about it. If you have a 3x uplift in revenue, let's say margins are stable and that also is combined with a 3x multiple increase on the price to earnings and the price to turnover, you would get a 9x or an 800% return on the stock. And I have this case study with HIMS. So for example, I first invested in HIMS back in December of 2023, and their price to sales at the time was about 2.2. Now their price to sales is 6.6. So we've had a 3x in uplift in valuation as the market has been comfortable applying a higher multiple to HIMS, which has been caused by the share price rise, obviously, because there's been demand for the shares because the market understands the thesis. So a key part of this is understanding the thesis early. As I said, when the jury is out on the stock, people are a little bit uncertain, and then you can get in at a much lower price to sales multiple. But if you have a 3x in the price to sales multiple, if you look at the same time that period, the quarterly revenue, when you annualize it, has doubled, way more than doubled. And what do you get? More than a 6x increase in the share price, because you've got a 3x in one and a slightly more than 2x in the other, results in slightly more than a 6x in the share price return. And thus, my shares of HIMS went from $8 a share to around $55 a share, where it's trading today. So my point is that close to a 7x in return is very remarkable. And when you combine this opportunity of growth investing, finding a company that has those high growth rates, but at those low multiples, you combine the best of both worlds with growth investing and value investing. And, there's a risk that if you find a company that is growing extremely fast, but it's priced for perfection, if anything goes wrong, there's multiple contraction. HIMS growing their revenue. So the last year that they'd reported at that time, I think they'd grown about 65 or 69% a year on their revenue for 2023. They were forecasted to be 61% growth by the analysts. And they previously grown 93.8% for the year 2022 at a price to sales of 2, just over 2, is quite remarkable, particularly given the company was at a profitability inflection point. You can take Tesla as another example. So if you look at Tesla's share price, obviously Tesla went through some headwinds in 2018, 2019. They were close to going bankrupt in 2018, but the long-term revenue was still growing. they were making it through bankruptcy. The share price was still kind of trading sideways and people were a bit unsure, and a lot of new Tesla investors had been scared out of the market. But what happened then, the price to sales multiple of Tesla contracted and contracted and contracted, and you were able to get it for a better and better deal. Come the end of 2019 and the beginning of 2020, Tesla announced a profitable quarter. They then had huge multiple expansion, and thus the shares had an insane return in 2020. However, if you'd invested in Tesla at the start of 2021, you would be flat, or maybe even less than flat, i.e. a negative return over the past 4 years. The shares have traded sideways because despite Tesla having a few years worth of growth, a couple years of very slow automotive revenue growth, but with promising minority businesses in energy storage, robotics, and autonomous driving, because the price to sales ratio was so high, it was very difficult for the market to allow any more expansion on the share price. Tesla being a $1 trillion company, one of the largest companies in the world behind the big hyperscaler tech, and thus the risk reward just didn't look so good. That's what you've got to remember investing in very expensive companies. The flip side of that then becomes how well you can analyze those future prospects. Because if you're correct about Tesla's full self-driving being a $1 trillion opportunity, and you're correct about Tesla's energy storage being a multi-tens billion-dollar opportunity or $100 billion opportunity, and thus robotics as well, you then assume that the market is severely underestimating the forward growth of these segments, which will ultimately dominate Tesla's revenue makeup in the future. And thus then that forward revenue growth will pull that price to sales multiple down. The risk reward becomes better whilst the company's fundamentals are improving, and thus then there becomes a new growth cycle for Tesla stock whereby the share price is poised to increase if you're right about the price to sales ratio being contracted relative to the risk reward opportunity. GitLab is another interesting example of this, and again, I'm not advocating to necessarily buy GitLab shares just based off this analysis, but it purely serves as an educational guideline, is that the revenue growth for GitLab has been very sustained. As you can see from this chart, the share price has been bouncing around a range of between $40 and $75 for the past couple of years, and thus the price to sales ratio is contracting and contracting. If you then conclude that GitLab's revenue growth rates will be sustained through the fact that they have a large runway of opportunity ahead of them, and the risk reward of the price to sales is very good, then you could have a scenario where the twin engines come into play simultaneously, and thus an extremely good share price return follows. i.e., if the market then realizes GitLab's opportunity through higher revenue growth, which pulls this price to sales ratio down, but the price to sales ratio is already at a multi-year low. Thus, if the market is willing to apply a higher price to sales ratio, let's say for example a price to sales ratio of 20, when at the moment GitLab is showing a price to sales of 10, and GitLab can double its revenue in the next 3 years, then you've got a doubling on both of the twin engines, and hence the share price will 4x. This is obviously an incredibly simplified example and doesn't go into the fact that margins change. Some of these companies aren't net profitable. A lot of them, of course, are still diluting stock because they need to raise money to go after growth opportunities, and some of them have debts to pay off, etc., etc. But I'm talking about turnover because these fast-growing companies have no interest in being completely optimized for the bottom line yet. There are a few rare examples, and CrowdStrike has come to mind, with very stable, high free cash flow margins above 30% over the past few years, and still growing revenue in the 20 to 30% range. But most of these companies are much more concerned with growing their top line. Revenue is one of the most stable metrics of performance that you can use, and thus using price to turnover with revenue growth to measure your twin engines potential is the way to go.